Afternoon, everyone. Thanks for coming out on not such a nice day in Sydney, even though it is nice to see some rain. Just, I guess, a disclaimer in the modern world. This is just a general advice, general information, not advice, sorry. Look, we have a fairly, simple objective, and it's really to maximise long-term returns to shareholders through a balance of capital and dividend growth. And through the economic cycle and what's happening with interest rates, capital is more important sometimes. Other times, probably like now, dividends are quite important. We just have a very good long history. Argo has been listed since 1946. It's one of the oldest and biggest LICs in the market. Nearly 87,000 shareholders, are trusting us with their money. And we're, different to the newer suite of LICs that have come to market and have had quite a lot of publicity over the last few years. We're internally managed, so I work for Argo, not a management company. And because of that, one, there's no conflict of interest, but two, the costs around the company are extremely low for an actively managed product. So 0.15%, which again, in the modern world, people definitely have eyes on fees and costs. And we're a large cap manager, so we're over a $6 billion portfolio. So a 1% investment for us is a $60 million investment. We recently had our full year result for which was pleasing to deliver a big kick in profit, a bump in the final dividend and the full year dividend. One of the other sort of anomalies or differences of Argo, and there's only a handful of these LICs in the market, is because of how we account for things. We don't trade a lot. We are treated on a capital account. We can pass on what's called an LIC capital gain to shareholders. It's really the tax deduction from us selling profits that you would get yourself as an individual. And we also had a 7% return. Now, we had a bit of a tailwind this year. Some of the bigger companies in the market, BHP and Rio, had significant divestments and they handed back big special dividends, which we were a beneficiary, and we passed it on to shareholders. The same with Wesfarmers, big special dividends. They won't repeat themselves, not to that same extent, but the model is, we earn out the income from all our investee companies and effectively pay it straight out after tax to shareholders. Pleasingly, it was, the 7th year in a row we've managed to increase the dividend, and as I said, through the cycle that has varying sort of interest for shareholders. With what interest rates have done in that time, that growing fully franked dividend stream has been much appreciated, and we've paid out over $1 billion of fully franked dividends in the last 5 years. This is the outcome over a very long period of time of what we're trying to do. We run a fairly diversified portfolio, and there's a couple of slides on that I'll touch on, with a low beta. So we want to go up when markets are going up, but we don't take a lot of risk. But what we do want to do is if markets are falling or they're volatile, as in the period we're starting to come into now, that we protect the capital and can still maintain and ideally grow the dividend through the cycle. We're across most of the market with a big cap portfolio. Of course, we have to be in some of the larger companies. We like some of the smaller companies as well for the diversity they provide, some of the different industry groups they're in that are growing, maybe quicker than a lot of your bigger holdings. But, our top holdings, are fairly familiar to people. One of the challenges of running a portfolio of that size is, we want to maintain a dividend, we want to grow a dividend, we want the capital growth. You may not know, but half the market's dividends come from 6 stocks. So the 4 banks, Telstra and BHP, pay out half of the total dividends of the ASX. And if you think about their earnings and results and dividends over the last few years, 2 banks have cut their dividends, Telstra's cut their dividend. So to get dividend growth, you need to be also looking elsewhere. So we think we've got a reasonable balance. We've got, some infrastructure and utilities which are pretty defensive at the moment, particularly with low interest rates. The health stocks, and these are 3 of what we'd say, very successful Australian companies that have got really good offshore businesses. We've got some of the big Australian, the consumer staples and Telstra, because they provide, the rump of that fully franked dividend for us. And then we've got some exposures through the QBEs, Aristocrats and Macquaries, which are sort of growing offshore. So those holdings are about 60% of our total portfolio. And I guess we've got about a very long tail of 60, 65 stocks that make up the other 40. So I guess, an LIC, and I probably haven't got a lot of time to go into detail. I mean, Argo may be familiar to a lot of you, at least the name. We're a very low cost, internally managed product, a very long-term track record and a focus on sort of maintaining and growing a fully franked dividend stream to shareholders. A few years ago, I guess, a lot of financial advisors and planners are always talking about it, domestic and retail investors' exposure to Australian equities, that we're probably overrepresented. We're attracted to dividends and franking credits. So we launched another LIC in 2015 called Argo Global Listed Infrastructure, or ALI is the code. Much smaller than Argo, but it is in its infancy. Still has a reasonable number of shareholders. And we set this up, one, to provide shareholders an opportunity in what we thought was a pretty defensive asset class, so global listed infrastructure. We've partnered with Cohen & Steers, who are one of the sort of global managers in infrastructure. They're one of the global leaders. They're actually the largest REIT manager in the world as well. So they manage the portfolio for us. They're based in New York. They're listed on the New York Stock Exchange, and they have offices around the world. We reported our result earlier this week, and it was a really good result for the company on many facets. The profit's up extremely high. Importantly, though, we're continuing to grow the dividend. It won't always be fully franked, but we're paying tax to the ATO on capital profits, so we've been able to fully frank the final dividend. The total dividends for the year was about 6.5 cents. The portfolio, 22, and the share price, 28, had great years relative to, I guess, the Australian market. So the Aussie market's about 11.5. The S&P accumulation index, the 200, and even the MSCI World in Aussie dollars was about 11%. So it's had a really good year, and I guess in what's happening with interest rates around the world, the US Fed has pivoted, the RBA's cut twice, and I guess forecasters are anticipating more cuts. Real estate, infrastructure, utilities, these asset classes tend to do quite well. The other thing we liked about the global infrastructure opportunity was there's some very good infrastructure companies in Australia, but they're quite limited in number. I think there's 13. APA, Transurban, Sydney, which Argo owns, come to mind. They also don't offer, I guess, the full spectrum of infrastructure. So there's the regulated utilities, very defensive, a lot of transport opportunities, I guess the structural growth in data and energy and pipelines. So going offshore enabled, one, exposure to a lot more varieties of infrastructure, quite often with the same characteristics, stable cash flows, often monopolistic in nature. But this, I guess, slide really sort of hones in on the pool of availability for a manager who is around the world, is tapped into different markets, and can, I guess, move within the infrastructure spectrum itself. So when global growth was strong, you may want a bit more exposure to marine ports and transport companies and the like of Union Pacific. When things are getting a little shaky, perhaps, you may want some more exposure to utilities. Florida Power and Light, for example, providing electricity to Florida. So the universe is large and gives a lot more opportunities, and the manager's done a good job and done in getting some alpha for the company and generating good income. So that's been a good story. It's an early story. I mean, I hope long after I'm gone that ALI is around and has the same history of Argo. But we think for the times, it's quite a defensive asset class. Again, it has a beta of about half the Aussie equity market. So in good times, it certainly won't go up quite as quickly, but in bad times, it certainly won't fall as much. And the dividend stream coming through infrastructure assets, doesn't deviate very often. I thought probably it's in the middle of reporting season. If you're following equities, you're probably well aware of that. All our public companies are reporting results. Today we had Ramsay Health, Woolworths, and many others. It's pretty challenging. We've got interest rates being cut around the world, which generally is good for asset classes. Investing in cash is safe, but is not giving much of a return. It's pushing people to look for other investments. On the counter to that, though, is through reporting season and leading in, there's a lot of companies, when they're looking forward over the next 6 to 12 months, their outlook is pretty soggy. So I guess, as we look at things, there's downgrades to expectations of what a lot of these companies are going to earn in the next 12 months. There's uncertainty about trade and what Donald's going to tweet tonight. Is it going to be different tomorrow? And markets moving around. And just the whole geopolitical environment, Brexit, these issues have been around for a while. But there's enough uncertainty at the high level and that is why interest rates are being cut. And so, we think it's a little challenging. So Argo itself has probably more cash than we've had for a few years. We're not earning much on cash, but we think that's a little prudent at the moment as we sort of work our way through reporting season. We're seeing management teams and I guess trying to get a feel from what are they seeing in the economy. Do they see, we're going to bumble on through? Do they have any fears, or are we all a bit pessimistic and things aren't so bad? So I'll probably leave it there. We'll be outside for a little while. Happy to chat about either of Argo's companies or the market, and thanks for coming.